Hey y'all, welcome to Financial Accounting 2. If you're in this class, that means you survived Financial Accounting 1, so congratulations. This is a summer course, so real quickly, just want to let you know, 8 weeks. We got 8 weeks. And that's okay, because we can do this in 8 weeks. So real quickly, if you had me for Financial Accounting 1, we will be doing things differently in Financial Accounting 2. First things first is here's a quick screenshot of Blackboard and what Blackboard looks like for you guys. You do need to still start in the Start Here module. So if you've not started here, go ahead and pause my video and go ahead and go through all of this before you start my video. This is going to give you a quick start guide on your syllabus, a quick syllabus review quiz, what's required for attendance, and then of course how to register for this course in Cengage, because it is a Cengage course. So if you've not gotten your subscription to Cengage, go ahead and do that as well, because you will be needing Cengage to access your book assignments as well as your tests. So I'm assuming if you're still watching the video, you've gone ahead and done all this. You've done all the steps and Start Here. So we can go ahead and go into our lessons. In lessons, you'll have all of your learning modules, and there's one for each week of the semester. So there's 1 through 8, as well as your midterm and your final exam. So let's go ahead and click in Learning Module 1. In Learning Module 1, we are going to be starting in Chapter 10 of your textbook, and that is still the same textbook you used in Financial Accounting 1. We're continuing in that textbook because we should have ended in Chapter 9, which was revenues, and we're starting in Chapter 10, which is fixed assets and intangible assets. So you will be expected to read Chapter 10, and you will be clicking on this link right here, and it will take you directly to your assignment in Cengage. So when you click on it, this is what's going to happen, because after you've registered for the course and you've gotten your subscription and everything, you're going to need to sign in just like you normally would, and it'll take you right to the course. Obviously, I haven't finished registering. I'm in as a student, but that's all you'd have to do. And then, of course, I have a link to your first discussion post. So if you look here, this will tell you what we will be doing for the week. So we'll be reading Chapter 10, and your learning and review resources will be a copy of this video, as well as any PowerPoints and any handouts that will be useful in completing your assignment for Chapter 1. Also, you're required to do a discussion post every week. And so this link right here will take you directly to that discussion post, as well as the requirements for completing that discussion post. So let's go ahead and get started with Chapter 10. Chapter 10, again, is long-term assets, your fixed and your intangible. This video is going to be in 2 parts. The first part, we're going to be discussing the nature of fixed assets, accounting for depreciation, and disposal of fixed assets. And then in the second half, we'll discuss natural resources, intangible assets, and the financial reporting for the long-term assets, both fixed and intangible. And then, of course, we're going to look at the fixed asset turnover ratio. So let's go ahead and get started. Let's talk about the nature of fixed assets. First of all, what is a fixed asset? Fixed assets are basically long-term or permanent assets. These are your equipments, your machinery, your building, your land. They exist physically, or therefore they're tangible assets. They are owned and used by the company in its normal operations, but they're not for sale as part of your normal operations. In other words, they're used to generate the goods or services that you provide that you do sell. So fixed assets are critical to the success of many businesses. For example, computers and internet services are critical fixed assets for a business that provides online retail or technology services. All right, so let's talk about classifying costs. Now, in Chapter 1 of Financial Accounting 1, we went over the cost concept, and that was, what do you record the cost? Well, we record the cost as the purchase price. Now that we know what the cost concept is and what amount we record it as, now we need to be able to classify that cost. So a cost that's been incurred can be classified as a fixed asset, an investment, or an expense. So in this exhibit 1, it kind of helps us determine the proper classification of a cost and how it should be recorded. So first thing you want to ask yourself is question 1, is the purchased item long lived? Meaning, does it have a life expectancy of more than 1 year? So if your answer is no, then it's an expense. You're done. But if the answer is yes, then you have to move on to question number 2. Is the asset used in normal operations? So if the answer is no, then it's considered an investment. In other words, you maybe purchase land for future use, but it's not in use now. So that would be considered an investment. But if the asset you purchased is going to be used in normal operations, then it's going to be classified as a fixed asset. Now, the cost of fixed assets. Now, again, we talked about cost concept. So the purchase price is obviously part of the cost, but there are other costs involved. And these are the acquiring of the fixed assets, which is money spent getting the asset in place and ready for use. And those include your freight costs and then maybe any installation costs if you're having the equipment professionally installed. So if you look at Exhibit 2, it lists different cost of acquiring fixed assets for different types of assets, whether building, machinery, land. So you got architect fees, engineering fees, insurance, interest, sales tax, repairs. You can read them for yourselves. Each type of fixed asset has its own list of additional costs that may come along with acquiring that fixed asset. Only costs necessary for preparing the fixed asset for use are included as a cost of the asset. Unnecessary costs that do not increase the asset's usefulness are recorded as an expense. For example, the following costs are recorded expense: vandalism, mistakes in installation, uninsured theft, damage, fines for not obtaining proper permits. To illustrate, we're going to use Kimball Incorporated purchased equipment for $12,000. Freight costs were $600 and to transport the equipment to the installation site, and on-site installation costs were $1,500. And that included $500 due to an error in installation. So the journal entry to record the equipment is as follows: equipment, which was $1,200 plus the $600 plus the $15 minus the $500. Okay. So that $1,500 installation cost included a $500 fee, additional cost due to error. Now, we talked about mistakes in installation should not be part of the cost of the fixed asset. So that's why we reduced it by $500. So the total cost of that equipment is $13,600. So again, the cost of the error in installing the equipment of $500 should not be included, and therefore is reduced. And a company may incur costs associated with constructing a fixed asset, such as new building. The direct costs incurred in the construction, such as labor and materials, should be capitalized as a debit to the account entitled Construction in Progress. All right, now let's talk about leasing fixed assets. A lease is a contract, and it's for use of an asset for a period of time. So in other words, you're not purchasing the asset, you're kind of borrowing it, and you're paying a fee to borrow it. So for example, automobiles can be leased. Medical equipment and buildings, you pay a lease to use a building. Those are very common leases for fixed assets. So the Financial Accounting Standards Board, FASB, and the International Accounting Standards Board, IASB, recently completed a project to merge U.S. and international standards on leasing. So I've talked about this in Financial Accounting 1, how we're going to see more and more of the FASB and the International Accounting Standards Boards merging as we become more of a global economy. The new FASB standard distinguishes between finance leases and operating leases. Under a finance lease, the leasee records an asset and a liability similar to having purchased the asset. Under an operating lease, the lessee records prepaid rent and of necessary liability for future lease payments and records rent expense as an asset as the asset is used. But I will say, for the purposes of this text, we will assume that all leases are operating leases and do not extend beyond 1 year. So lease payments are recorded by debiting rent expense and crediting cash. So in some cases, like those illustrated in earlier chapters, prepaid rent is initially recorded with an adjusting entry at the end of the period to record rent expense. But regardless of the type of lease terms should be disclosed in the notes to the financial statements, and these disclosures will include such items as the length of the lease, termination rights, and renewal options. All right, now we're going to talk about depreciation and the accounting for depreciation. So what is depreciation? All right. Over time, fixed assets, with the exception of land, lose their value. They lose their ability to provide services. Thus, the cost of fixed assets, such as equipment, buildings should be recorded as an expense over their useful lives. Recording the cost of fixed assets as an expense is called depreciation. So cars are the best example I can give, because everybody understands that cars over time depreciate in value. Well, your equipment and your buildings that you're using in your daily operations also depreciate in value, and you have to record that depreciation as an expense on your books. Now, everybody knows land has an unlimited life, therefore it doesn't depreciate, which is why land is not included in this. All right, so depreciation can be caused by physical or functional factors. So physical depreciation, obvious one, factors include wear and tear. Functional depreciation factors include obsoletes and changes in the customer needs that cause the asset to no longer provide services. Computers are a really good example of equipment that may become obsolete due to changing in technology. 2 common misunderstandings about depreciation. Depreciation does not measure a decline in the market value of a fixed asset. Instead, depreciation is an allocation of a fixed asset's cost to expense over the asset's useful life. Thus, the book value of a fixed asset, cost less accumulated depreciation, that's your book value, usually does not agree with the asset's market value. This is justified in accounting because a fixed asset is for use in a company's operations rather than for resale. So we're not talking about market value, we're talking about book value. Those are 2 different things. When we're talking about depreciation, we're recording the book value. Now, depreciation does not provide cash to replace fixed assets as they wear out. This misunderstanding may occur because depreciation, unlike many expenses, does not represent an outlay of cash, but instead is an allocation of the asset's initial cost to expense. In other words, we are expensing the depreciation, but we're not using cash to offset the expense. What we're doing is we're basically decreasing the value of that asset. So factors in computing depreciation expense. There's 3 factors that determine the depreciation expense for a fixed asset: the asset's initial cost, the asset's expected useful life, and the asset's estimated residual value. Okay, so the initial cost of an asset is the purchase price of the asset plus all the costs to obtain and ready it for use. So the initial cost is determined using the concepts discussed earlier, such as, the purchase price, freight costs, and installation costs. All right. The expected useful life of a fixed asset is the estimated length of time the asset will be used in normal operations. It is estimated at the time the asset is placed into service. Estimates of expected useful lives are available from industry trade associations. The IRS also publishes guidelines for useful lives, which may be helpful for financial reporting purposes. However, it's not uncommon for different companies to use different useful lives for similar assets. The residual value of an asset is the estimated value of the asset as the end of its useful life. It is estimated at the time the asset is placed into service. So residual value is sometimes referred to as the scrap value or the salvage value or the trade-in value. All right, now the difference between a fixed asset's initial cost and its residual value is sometimes called the depreciable cost. This is the asset's cost that is allocated over its useful life as depreciation expense. If a fixed asset has no residual value, then its entire cost should be allocated to depreciation. So in other words, throughout the asset's useful life, if the depreciation expense declines at a rate to where at the end of its useful life, the entire cost of the asset has been depreciated into the depreciation expense, then it has no residual value. But at the end of the useful life, the total value of that asset had not been expensed out to depreciation expense, then the remaining value is the residual value. Now, there's three depreciation methods that are most often used. There's a straight line depreciation. There is the units of activity depreciation. And there's a double declining balance depreciation. And up here, depreciation expense, real quickly in Exhibit 3 before we move on to the three different methods. Let's discuss this exhibit really quickly. Again, we talked about the initial cost less the residual value. That should be the total depreciation cost. Now, if it has a useful life of 5 years, the depreciation cost will be depreciated into the depreciation expense account throughout the 5 years. And that's basically how it works. Now, if the depreciation cost is equal to the initial cost, then there would be no residual value. Now, the three methods, it's not necessary for a company to use only one method of computing depreciation for all of its assets. For example, a company may use one method for depreciation equipment and another method for depreciation in buildings. So you don't have to use one method for every asset. You can use different methods depending on the type of asset. So let's talk about straight line method. The straight line method provides the same amount of depreciation expense for each year of the asset's useful life. The annual straight line depreciation for Exeter's forklift is $4,400, computed as follows. So annual depreciation equals cost minus residual value divided by the useful life. So if the equipment costs $24,000, the residual value is determined to be $2,000. You take 24,000 minus 2,000, divide that by 5 years, which is the total useful life. And then that gives you your straight line depreciation of 4,400, which is that's the amount that will be recorded as the depreciation expense for each year of that forklift's useful life. So in Exhibit 4, you can see the straight line method reports the same amount of depreciation expense each year, which is basically about 20% each year is how much is depreciated. Now, computing straight line depreciation may be simplified by converting the annual depreciation to a percentage of the depreciable cost. And the straight line percentage is then determined by dividing 100% by the number of years. So in other words, since it's a 5-year useful life, then you would take 100%, divide it by 5, and then that tells you what percentage of the total cost that, so in other words, you would take 20% of the depreciable cost, which is 22,000, and that's how much you would depreciate each year. Now, for the preceding equipment, the annual depreciation of 4,400 can be computed by multiplying the depreciation cost of 22,000 by 20%, which we just talked about. We got the 20% because it had a 5-year useful life. So 100% divided by 5, 20%, then 20% times the total depreciable cost of the equipment of 22,000 gives us 4,400. Now let's talk about how do we record that onto the books. So depreciation of the forklift for the first year using the straight line method will be recorded as follows. All right, so we talked about that it does not reduce your cash balance. Although we are recording an expense, we're not reducing our cash balance. What we're going to do is our offsetting entry is that accumulated depreciation contra asset account that we discussed when we talked about this in Financial Accounting 1. This is actually a balance sheet account that shows up under the asset itself. So you would have the initial value of the asset and then less the accumulated depreciation on the balance sheet. So every time you record each year's depreciation on the balance sheet, the accumulated depreciation would continue to increase until it reached the full depreciation cost of $22,000. So at the end of 5 years on the balance sheet, what you should see is you should see the asset at the cost of $24,000 and less the accumulated depreciation of $22,000, leaving the residual value of $2,000. Now, accumulated depreciation accounts, again, are called the contra accounts or contra assets accounts. And these are because the accumulated depreciation accounts are deducted from the related fixed asset accounts on the balance sheet. I just discussed that. Now, the difference between the fixed asset account and its contra asset account, the accumulated depreciation account, is called the book value. Again, this is not the same as market value. This is the book value, which is the value of the equipment less the depreciation. So in the first year, if you look here, the equipment is valued at $24,000 less the first year's accumulated depreciation of $4,400. So now the book value of that equipment is $19,600. So let's look at the straight line method, depreciation expense, and book value. So the depreciation expense per year, straight line method, $4,400 each year. The book value at the end of the year, as we see, is declining, so that at the end of year 5, the book value should be the residual value of $2,000. The straight line method is simple to use, and when an asset's revenues are about the same from period to period, straight line depreciation provides good matching of depreciation expense with the asset's revenues. So let's look at exercise example 1. Equipment acquired at the beginning of the year at a cost of $125,000 has an estimated residual value of $5,000 and an estimated useful life of 10 years. Determine the depreciable cost, the straight line rate, and the annual straight line depreciation. So first, what we would do to determine the depreciable cost is we would take the cost of $125,000, all right, minus the residual value of $5,000, and that gives you your depreciable cost. All right, determining the straight line rate, you could do that by basically says that it has a useful life of 10 years. So 100% divided by 10 means it's got a 10% straight line depreciation rate. So that's how we would calculate the straight line rate, is just basically taking 100% divided by its useful life of 10 years, and that means it's going to depreciate 10% of its depreciable cost every single year of its useful life. Now, the annual straight line depreciation. So you could do this several different ways. You could do it by taking $120,000, which is your depreciable cost, and dividing it by 10 years, and that'll give you your total depreciation amount. Or you could take 120,000 and divide it and multiply it by 10%. So it's either a multiplication or a division. So you're either going to divide it by 10 years, or you're going to multiply the depreciation cost by 10%. And so your depreciation for every year will be $12,000. And that's how much it should depreciate every year over the next 10 years. And then so at 125,000, if you depreciate the value of that by 12,000 over 10 years, at the end of 10 years, you should have a residual value of $5,000. Now let's talk about the units of activity method. Okay, the units of activity method provides the same amount of depreciation expense for each unit of activity of the asset. Depending on the asset, the units of activity can be expressed in terms of hours or miles driven or quantity produced. So, for example, the unit of activity of a truck is normally expressed in miles. So we do determine the value of a vehicle based on its mileage. So for manufacturing assets, the units of activity are often expressed in units of product. So in other words, how many products has that particular piece of equipment produced? And that could be its unit of activity measurement for determining its depreciation expense. So in this case, the units of activity method may be called the units of production method or the units of output method. So let's look how to apply the units of activity method. So let's look at step one. Step one, determine the depreciation per unit as follows. So here's your basic equation. The depreciation per unit is equals the cost minus the residual value, which is similar to the straight line method. So that's pretty much similar. But instead of dividing it by its useful life, we're going to divide it by the total estimated units of activity. All right. So to compute the depreciation expense, we will then take the depreciation per unit times the units of activity for period. Of the period. So that's worded odd. Okay. So let's get into some numbers instead of just talking about it. Let's just look into some numbers. So let's talk about that same forklift. All right. Now let's say that forklift has instead of an estimated useful life of 5 years, we're going to say it has an estimated useful life of 10,000 operating hours. All right. So during the first year, the forklift was operated at 2,100 hours. So the units of activity depreciation for the year is 4,620. Let's look at how we came up with that number. Okay, so in step one, we're going to take the cost less the residual value. So if we remember that in the straight line method, the cost was 24,000 less $2,000. Okay, so depreciation cost is $22,000. Now, it tells us the total estimated unit of activity is 10,000 hours. So we're going to take that 22,000 depreciation cost and divide it by 10,000 hours. And that means it depreciates a total of $2.20 per hour that it's being used. All right. Now, to get that depreciation expense, we know in the first year that forklift was used for 2,100 hours. So we're going to take that $2.20 and multiply it by 2,100. And that gives us a complete depreciation expense for year one of $4,620. And then we will record it the same way. We would debit the depreciation expense and we would credit the accumulated depreciation for that forklift. Again, the accumulated depreciation account is a contra asset account. So this is a balance sheet account. This is an income statement account. So we're going to hit expense and then we're going to hit our contra asset. Now, if we assume that during its 5-year life, the forklift was used as follows. So year one, it was used for 2,100, year two, 1,500, 2,600, 1,800, 2,000. So by the end of year 5, okay, because it had a useful life of 5 years, we used it for 10,000 hours. So each of these we would multiply by $2.20, and that's what we would then record each year for the depreciation expense. The first year it was 2,100, so we recorded $2.20 times 2,100, which was 4,620. Then year two, we would take that $2.20 per hour and multiply it by 15, then by 2,600, then by 1,800, then by 2,000. And here is an example of what the expense would have been each year. So on the units of activity method, now on the straight line method, it was all the same. So it was straight across, hence the straight line method. It was just straight across. But in the units of activity, if we look here, it's all based on hours it was used that year. So it does fluctuate. But we can see the declining in the book value at the end of each year. And at the end of year 5, we were still left with a residual value of $2,000. Now, so let's look at the example exercise 2 for these units of activity depreciation. So the equipment acquired at the beginning of the year at a cost of $180,000 has an estimated residual value of $10,000, has an estimated useful life of 40,000 hours, and was operated for 3,600 hours during the year. So, all right, again, let's go over that. It has a cost of 180,000, residual value of 10,000, and an estimated useful life of 40,000 hours. All right, so the first thing we need to do is the depreciable cost. Then we need to determine the depreciable rate, and then the units of activity depreciation for the year. So let's go ahead and click on the answer. How do we get the depreciation cost? All right, well, the depreciable cost is the cost of the asset less its estimated residual value. All right, so that's your depreciable cost. No matter if you're using straight line method or units of activity method, how you determine the depreciable cost is the same. You're going to take the cost of the total cost of the asset less the residual value. So it's 170,000 is the depreciable cost. Now we need to determine the depreciable rate. So the depreciable rate is you take the depreciable cost and divide it by its units of activity. And this units of activity is 40,000 hours. So $170,000 divided by 40,000 hours gives us a depreciable rate of $4.25 per hour. All right. Now it asks us the units of activity depreciation for that year. Well, it told us that the equipment was operated at 3,600 hours. So we're going to take that $4.25 and multiply it by 3,600. So our units of activity depreciation for that year was 15,300. Now let's talk about the double declining balance method. This provides a declining periodic expense over the expected useful life of the asset. The double declining balance method is applied in the following 3 steps. First, you determine the straight line percentage using the expected useful life. 2, determine the double declining balance rate by multiplying the straight line rate times 2. Then compute the depreciation expense by multiplying the double declining rate times the book value of the asset. All right, so let's put that in some practical use and let's see how this applies. To illustrate we're going to talk again about the forklift. All right, so we're still using the same example, the forklift. All right, so Extra's forklift is used to compute the double declining balance depreciation for the first year. The depreciation is 9,600. And here's how we came up with 9,600. So first, we're going to do the straight line percentage. So we know it has a 5-year useful life. So we're going to take 100%, divide it by 5. So we know the straight line percentage is 20%. So it's going to decline 20% over the next 5 years. All right, now the double declining rate, we're going to take that 20% and we're going to multiply it by 2. Okay, which means 40%. So now the depreciation expense equals 24,000, which is the value of the asset, times 40%. Now notice we did not do it we did not multiply it by the depreciation cost. We multiplied it by the cost of the actual asset, the value of the asset itself, 24,000. So it's 9,600. That's how we came up with 9,600. So the depreciation of the forklift for the first year using the double declining balance method is recorded as follows. So again, you're going to hit the depreciation expense as a debit, and you're going to credit the contra asset account for the accumulated depreciation. Now, for the first year, the book value of the equipment is its initial cost, 24,000. We talked about that. We didn't do the depreciable cost. We did the book value of the equipment is its initial cost of 24,000. Now, after the first year, the book value declines, unless the depreciation also declines. And the double declining balance depreciation for the full 5-year life of these is as follows. So, how this works is we're basically going to this right here, this entry right here. As you know, this is what calculates the book value. So the initial book value of the equipment before any depreciation was recorded was $24,000. So now we've recorded the first year's depreciation of $9,600. So now the book value of that equipment, if you look right here, is $14,400 because we've recorded the depreciation. All right. So now we're going to take that book value and multiply it by 40%. Okay. And that's the new depreciation for the next year, which now calculates the book value of 8,640. So then we come down here and we continue. Now the book value beginning of year 3 is 8,640, multiply it by 40%. So the depreciation value is now 3,456, giving a new book value of 5,184. So then we go to the beginning of year 4, okay, and the book value for that asset is 5,184. Multiply that by 40%. The depreciation is $2,073.60, giving it a new book value of $3,110.40. And to get it to the residual value in the last year, the difference between the book value and the residual value is what you depreciate. So let's look at this double declining balance method. So basically we are taking 40% of the book value, not the depreciable cost. You know, we determined, we took the value less the residual value and multiply that by either the useful life or the units of activity in the first two methods. Here, what we're doing is we're taking the double declining. So we're taking the straight line method, getting that percentage, multiplying it by 2, and then multiplying that percentage by the book value. And again, the book value is the value less the depreciation cost. So every year, the book value decreased by what was being recorded as a depreciation cost. Therefore, the amount that was being multiplied by the double declining rate decreased. So you can kind of see that pattern here. So if we look here, the amount that we depreciate each year also declines. So here is declining, and along with the book value is declining. So revenues generated by an asset are often greater in the earlier years of its use than in the later years. So in such cases, the double declining balance method provides a good matching of depreciation expense with its assets revenues. All right, so now let's look at the example exercise 3. So it says equipment acquired at the beginning of the year at a cost of $125,000 has an estimated residual value of $5,000 and an estimated useful life of 10 years. Determine the double declining rate and the double declining balance depreciation for the first year. So obviously we're going to take 10 years, okay? So we're going to divide 100% by 10 years, which is 20%. Now we're going to do the double declining. So we're going to take that 20% and we're going to multiply by 2. So the so we're going to take 10% and multiply by 2. So it's 10 years. So 100% divided by 10 equals 10% times 2 equals 20%. 20% is your double declining balance rate. So again, you're going to take 100%, divide it by its useful life. Useful life is 10 years. So 100% divided by 10 equals 10%. Now it's double declining. So you're going to multiply that by 2. All right. So 10% times 2 equals 20%. That is your double declining balance rate. Now, what is your double declining balance depreciation for the first year? You're going to take the initial book value, which is $125,000, and you're going to multiply it by that double declining rate of 20%. So in that first year, your double decline depreciation will be recorded as $25,000. So you would record the depreciation expense 25,000, and you would record the contra asset accumulative depreciation entry at 25,000, thus reducing the book value to 100,000. So then the next year you would take 100,000 and multiply that by 20%, and that would be your new double declining balance depreciation for the second year. And then you would continue in that pattern until you get to the last year of its useful life. And as it showed here, in the last year of its useful life, we know it has a residual value of 2,000. So it just recorded the difference between the book value at the beginning of the year and the book value at the end of the year, which should be the residual value. And that was what was recorded as your depreciation expense, was just the difference between these two numbers. Now, comparing depreciation methods. Okay, so there are 3 depreciation methods. They all allocate the total cost of an asset to a depreciation expense over the asset's useful life, and while never depreciating the asset below its residual value. Okay, so here's just kind of like some chart here, giving you a summary of the different depreciation methods. So you have straight line. Its useful life is based in years. The cost, the depreciable cost is cost less residual value. The depreciation rate is a straight line rate. So it's basically its useful life divided by 100% divided by its useful life gives you its rate, and it's constant. It's the same every single year. All right. Units of activity, its useful life is its units of activities, whether it's based on hours of use or miles or number of products produced. That is what is used. So the cost is less the residual value. And then depreciation rate is the depreciable cost divided by the total units of activity. And every year it's a variable. So it's because it depends on the units of activity as to how much the depreciation expense is. And the double declining useful life, again, is years. The depreciable cost is the declining book value, but never below the residual value. And the depreciation rate is your straight line rate times 2, and the depreciation expense is constantly declining. So let's look at this. So the straight line method provides for the same periodic amounts of depreciation expense over the life of the asset. So the units of activity method provides periodic amounts of depreciation expense that vary depending on the amount the asset is used. And the double declining balance provides for a higher depreciation amount in the first year of the asset's use, followed by declining amounts. Exhibit 9 illustrates depreciation expense for each depreciation method over the 5-year life of the forklift. So here, it kind of shows you, I like this one here. I like anything that's colorful. So in the blue is your straight line. So as you can see in the blue, it's the same amount every single year. Okay. The green is your double declining. So you can see how with the amount you depreciate each year declines as the value, the book value of the asset declines, what you depreciate declines. And then the units of activity, as you can see, is variable, and that is all based on how much that asset is used, whether it's hours used, miles used, or number of products produced. Let's talk about disposal of fixed assets. Okay, so fixed assets are no longer useful and may be just discarded or sold. In such cases, the fixed asset is removed from the accounts. So just because a fixed asset is fully depreciated, however, does not mean that it should be removed from the accounts. If a fixed asset is still being used, its cost and accumulated depreciation should remain in the ledger, even if the asset is fully depreciated. If the asset was removed from the ledger, the accounts would contain no evidence of their continued existence. In addition, cost and accumulated depreciation data on such assets are often needed for property tax and income tax reports. So discarding a fixed asset. Again, as we mentioned a minute ago, if a fixed asset is no longer used and has no residual value, it is discarded. For example, assume that a fixed asset is fully depreciated, it has no residual value, and is discarded. The discarded asset is and its accumulated depreciation are removed from the accounts and the ledger. So to illustrate, assume the equipment acquired at a cost of $25,000 with no residual value is fully depreciated on February 14th, the equipment is discarded. And this is how you would record that to the ledger. So you would go ahead and zero out that contra asset account, the accumulated depreciation account, by the total value of the equipment, which is 25,000, and then you would reduce the asset entry of that equipment of 25,000. And this is how you write off equipment that's been discarded. So you're basically just zeroing out this contra asset and zeroing out this asset account. Now, if an asset has not been fully depreciated, depreciation should be recorded before removing the asset from the accounting records. To illustrate, assume the equipment costing $6,000 with no estimated residual value is depreciated at a straight line rate of 10%. The accumulated depreciation balance after adjusting entries is $4,650 on December 31st. On March 24th of the following year, the asset is removed from service and discarded. The entry to record the depreciation for the 3 months before the asset is discarded is as follows. So basically, you would need to take the 600 and divide it by 3/12, or multiply by 3/12, which basically is just simple math because it was only 3 out of the 12 months. And so that would be the total amount of excuse me, your depreciation expense. So let's address this really quickly. The 600. Okay, so the 3/12 is easy because it's March. It's the 3rd month of the year. So it's basically 3 divided by 12 is 0.25. All right, so basically 0.25 of 600 gives you the 150. Now, where did the 600 come from? Well, it says here that the equipment costs 6,000 with an estimated residual value, with no estimating residual value. It depreciates at a straight line up to 10%. So 10% of $6,000 is your 600. So then your 600 times 3/12 gives you the 150. So this is the entry to record the depreciation for the 3 months before the asset is discarded as. So you would record your depreciation expense, and then you would go ahead and record your contra asset accumulative depreciation. So you would debit depreciation expense and credit accumulated depreciation at the $150 rate. Now, the discarding of the equipment will then be recorded as follows. The accumulated depreciation of $4,800. So that would be the $4,650 plus the $150. So you're going to go ahead and zero out that account with a debit of $4,800. And you're going to record a loss on disposable equipment of $1,200 because that's the difference between $4,800 and $6,000 because now you've depreciated only $4,800. The total the equipment cost was $6,000. So you are going to record a loss on the disposal of the equipment of $1,200. And then, of course, you're going to zero out your asset account of $6,000. The loss of the $1,200 is recorded because the balance of the accumulated depreciation account of $4,800 is less than the balance of the equipment account $6,000. So losses on the discarding of fixed assets are reported on the income statement. So that would actually be recorded as an expense on the income statement right here. So now we're going to talk about selling fixed assets. The entry to record the sale of a fixed asset is similar to the entry for discarding an asset. The only difference is that the receipt of cash is also recorded. If the selling price is more than the book value of the asset, a gain is recorded. If the selling price is less than the book value, a loss is recorded. So let's look at some examples. assume the equipment is purchased at a cost of $10,000 with no estimated residual value, and it depreciated at a straight line rate of 10%. Okay, so the equipment is sold for cash on October of the 8th year of its use. All right, so the balance of the accumulated depreciation account is as the preceding December 31st is $7,000. So the entry to update the depreciation for the 9 months of the current year as follows. So again, you're going to take the 10,000, multiply it by the 9/12 times the 10%, which is going to give you the $750. And that's what you're going to go ahead and record as the depreciation expense. And then after the current depreciation is recorded, the book value of the asset is $2,250, which is 10,000 minus the 7,750, which is the 7,000 plus the 750 you just recorded. So you're going to take the 10,000, which is the purchase price of the equipment, less the total depreciation expense, and that gives you the new book value of the asset. Now, if you sold at book value, there's no gain or loss. Okay, so you would record the cash of $2,250. You would then go ahead and zero out your accumulative depreciation account and zero out your equipment account, and they all balance back to the 10,000. You have the book value plus the accumulative depreciation, which equals that. Now, let's say you sold below book value. So let's say you sold it for $1,000. Now book value is the same, 2,250, but you sold it for $1,000. You would then record the cash. You would record the accumulative depreciation, but then you would record the loss of the sale because you lost $1,250 on the sale. Now let's say you sold above book value. Okay, this is how the interest would look. Again, you're going to record the cash for the sale. So if you notice, the cash is what you sell it at, no matter what. If it's no gain, no loss, loss or gain, your cash is what you sold it for. You're still going to zero out your accumulative depreciation account. So those do not change. You're still going to zero out your equipment account. So those do not change. The only thing that's going to change is whether you're going to record a loss or a gain on the sale of the equipment. And if you remember, your debits and your credits have to balance. So you go ahead and record these three because these three are your constants. They're not going to change. To determine if you have a loss or a gain is whether or not you need to record a debit or you need to record a credit so that both of your columns balance. If your cash, if your total cash and total accumulative depreciation do not equal the value of the equipment, then you know you had a loss on the sale of the equipment, and therefore you need to record a debit to the loss on sale of equipment. If your cash and accumulative depreciation are more than the value of the equipment, then you get to record a credit to your gain on the sale of the equipment. So let's do a few examples. Equipment was acquired at the beginning of the year at a cost of $91,000. The equipment was depreciated using the straight line method based on an estimated useful life of 9 years and an estimated residual value of $10,000. So what was the depreciation for the first year? So let's go ahead and look at that. So we're going to take the value of the equipment, which is $91,000. We're going to reduce it by the residual value of $10,000, which is $81,000. And it has a useful life of 9 years. We're going to divide that by 9. So the depreciation for the first year was $9,000. Assuming that the equipment was sold at the end of the second year for $78,000, determine the gain or loss on the sale of the equipment. All right, so we have $91,000. Okay. That is the original book value of the equipment. All right, we know based on straight line, it's going to decrease 9,000 per year. So we're going to take 91,000 minus 9,000 times 2. So basically $91,000 minus $18,000. And that's going to give us a value of $78,000. Excuse me, that's not correct. I'm sorry. So $91,000 minus $18,000 is going to give us a value of $73,000. So that would be the book value of the equipment at the end of year 2. And we sold it for $78,000. So that gave us a $5,000 gain. Again, the value of the equipment was $91,000. We know based on the straight line method, it declines $9,000 in depreciation each year. So $91,000 minus $18,000 is a book value of $73,000. And we sold it for $78,000. So that gave us a $5,000 gain. So the next question it asks is to journalize the entry to record the sale. So the first thing we're going to do is we sold it for $78,000. So we're going to hit cash for $78,000. We know the accumulated depreciation that we recorded thus far was $18,000. So we're going to hit a debit to accumulated depreciation for $18,000 to zero out our cumulative depreciation account. And we know the value of the equipment was $91,000. So we're going to credit our asset account for the equipment of $91,000, thus zeroing out that account. So since $91,000 minus $18,000 is $73,000, and we sold it for $78,000, we get to then record a $5,000 gain on the sale of the equipment. We're going to stop there today. Our next video, we'll pick up on with natural resources, and we'll discuss natural resources as well as intangible assets. And then we're going to also discuss the fixed asset ratio.